Hey guys, it's Cameron here with Emerson House Buyers. Um, Another format, we're trying something a little differently. I want to show you guys a subject to property and subject to wrap to owner finance. So that's what I'm going to be walking through today. I'm going to walking through on the whiteboard again. We're going to go by step and show you all the numbers the exact way the first owner finance property that I did, the first subject to and owner finance property that I did, all those numbers and just put some real life situation to it because I know you guys are sometimes just sitting there talking, not having anything, not having something tangible or at least something some numbers to see. It makes it sometimes confusing. So again, why would you listen to me? I'm out there buying real estate in Houston and Athens, Ohio, and I built up a sizable rental portfolio over the past year, and I just want to share and give back because real estate's been very influential part in my life and allowed me to gain a certain sense of security that I don't think any other investment would have. So bear with me, guys. New format. I'm trying some things differently. So if I screw up, just bear with me. We do this live. I'm not into editing and doing everything. This is what you see is what you get. But I am trying to help. I am out there on the streets. I am buying real estate. So guys, I know what's going on in these certain areas, and we're going to walk through an owner finance, a subject to owner finance today, and I'm going to show you all the numbers. This was a Cholla Canyon property that we did last year. This is the first one I did, but I think the numbers are fantastic. I think you guys would really like it. So if you guys are thinking about low no money down strategy, this is a perfect one for you. This will be something that you can use with little or no money out of pocket. I've talked about other strategies. I know there are other videos on low and no money down strategy. This is just one tool in your tool belt. So let's sit here and get this going. So Cholla Canyon is a property name. Purchase price, we were at one, I say purchase price, we assume the loan at 125. Let me grab another marker here, guys. So I assumed the loan at 125. I hope you guys can see that. It needed the repairs were 15,000. So we're all in at 140, right? 140K. So this, actually the out-of-pocket cost was $0. This actually cost me a little bit in closing, 2,000 bucks, but we're going to ignore closing costs just for simplicity's sake because I don't want to get into all that. But we'll just say it was very little out of pocket to assume this seller's $125,000 loan. Needed 15 in repairs, got it to 140. That's what we're all in. All in at 140. Sold this, so we sold it, owner finance, sold owner finance at 160,000. They put, the down payment was, um, 40,000, or excuse me, 30,000. And I give them an interest rate, so I finance, no, it was 40,000. So we have $120,000, no, I'm screwing up here, guys, bear with me. So I financed 130K, which is 60 minus 30. So that equals 130. I financed 130K at 8.5%, amortized 15 years. 15 years. Okay? So after everything was said and done, realtor fees, closing costs, all that good mumbo jumbo, I walked away with about 15,000 in my pocket up front, plus a monthly monthly cash flow of, I think it's $311 a month. 311, sorry guys, deal with my chicken scratches. It was $311 a month. And that's for 15 years, until they pay it off. So how did this all work? So let me just walk back through this. Purchase price, $125,000. We assumed the loan, or I assumed the loan, the company assumed the loan. Just had to do closing costs on that, so very minimal out-of-pocket costs, virtually nothing. I had to put in some repair costs, $15,000. It was all in at $140,000. We sold it owner finance at $160,000. Down payment of $30,000. Financed $130,000, which is the $160,000 minus $30,000. Financed $130,000 at 8.5%, amortized 15 years. So that allowed me $15,000 in my pocket, plus $311 per month. So that rate of return is pretty gosh darn good. Now let me get into a little more of the details behind how this all works. So let's look at that $311 per month. So they had a loan, we'll just say it was, I'm not going to say the company, I don't know if I can. There was a loan at $125,000. So the underlying loan was $125,000 at 4%. Let me check my numbers here, guys. I don't want to tell you wrong. So underlying loan, we financed $130,000 at 8.5%. See here, I guess pulling it up on the screen, guys. It was actually 3.75, and the final note let's see here. Sorry guys, bear with me. Okay. There we are. Okay. So this monthly payment was was $940.35. $940.35. That's what we had to pay. And then they were paying us $12.80. $12.80 a month. $12.80. Okay, so I'm going to use a different marker here. We're running out. I'm wearing these markers out, man. Let's see, this is blue. Oh, nice. Blue look good. Okay, so bear with me here. I have to pay $940 a month. This is just principal and interest. This isn't taxes and insurance, but I'll get into that. So this is the principal and interest, the principal and interest. So I had to pay this because I took over that loan. I have to pay that. But the lady that I sold it to has to pay me $130,000 loan at 8.5%, which is $1,280. So the difference, so she pays me $1,280, and I have to pay this. So this has to go out, this comes in. This is a positive. So what's the difference there? It's $339 and 81 cents. So cash flow is $339 a month and 81 cents. again, that is going out because I took over a mortgage, right? Just like you go out and get a mortgage. You have to pay the $940 a month, whatever it is. But I wrapped the old mortgage with a new loan when I owner financed it at 130 at that, which they have to pay. The end buyer has to pay me. I'm acting as the bank. I'm acting as Chase, Wells Fargo, all the big banks. That's who I'm acting as. They have to pay me the principal and interest balance of 130 at 8.5% for 15 years, which is 1280.16. So I make 339. I take in 1280. I put out 940. So if for some of you I'm being a little repetitive, I just want to make sure everybody's clear on that. So you guys are going to ask, well, what about taxes and insurance? Does Wells Fargo or Chase pay your taxes and insurance for you? No. You put it in either an escrow or you pay it at the end of the year. So it doesn't matter if the taxes on this are $300, $400, $500 a month because they have to pay, the end buyer has to pay the $300, the $400, the $500 a month. All you're doing is loaning them money to buy the property. That's all you're doing. You're not doing anything else but loaning them money on the property. So if a repair comes up, or if you have any maintenance, any issues, you're still making $339.81. The downside is if they don't pay. That's the only thing that can happen. They don't pay and they trash the house. And you have to go into foreclosure, or you have to file foreclosure on them. But as long as they're paying, no matter what, if the taxes go down, up, sideways, if the insurance goes up, down, sideways, doesn't matter. You are only responsible for making this payment, and the taxes and insurance are passed on to your end buyer. Does that make sense? The arbitrage, the difference, you're just making the arbitrage on the difference of these two notes. The taxes and insurance are the same on both. So that right there is a subject to taking over somebody's loan and wrapping it, selling it owner finance at this other rate. Now, I know it can be a little confusing, guys. Please, below, comment, ask questions. I can dive into more of these details and let you guys know some more bits and pieces of the process, if need be. I might have been too repetitive, guys. I apologize. I just know that this was a difficult process for me to figure out, but I'm a little slow. So just bear with me a little bit through this. Or I hope you did bear with me through it. What else? That's about it, guys. I mean, you make the $339 a month. The downside is if they don't pay, you take the property back. You have to file foreclosure. But then again, you got a $160,000 house that you only owe $125 on. Worst case scenario, could you rent it? Maybe. Could you sell it? Probably. Even if you sold it at 140 or 150, you're going to walk away with some money. So this isn't the only way to do this strategy. There are people who don't fix it up at all and wrap loans. This is just one strategy that we use, subject to taking over payments from somebody and then selling it owner finance. So it's as simple as a numbers game. You punch in some numbers, you got calculators that'll tell you what these monthly payments are going to be, and that's it. If this payment is more than this payment, depending upon how much money you want to make a month, you say yes or no. You can increase the interest rate, you can decrease the interest rate, whatever it takes. Guys, really hope this helped. I know it's a convoluted process. This is something that real estate investors use all the time. A lot of realtors aren't familiar with this process, so they get a little weary of it. But it's a great strategy for people who are going into foreclosure, who just don't want to fix up the house, and maybe they have poor credit. You're making payments every time you're making payments on time every month. That can help their credit because you're actually making payments on behalf of the lady or individuals that you took over payments for. And then you get to give somebody a property. You know, you might be asking, why in the world would anybody get 8.5% interest when I can go out right now and get 4% or 5%? Well, these people are self-employed typically, And the banks hate inconsistency. They can't stand inconsistency. So they don't particularly like people who are self-employed because you have that, up and down income. You don't have a steady W-2 job where you're making $2,000 every 2 weeks, you know. So that in itself allows people, creates an opportunity for people to have a house and be able to get into a house. A lot of people are tired of throwing away money. So self-employed people and are just trying to get a home and they can't with the lending restrictions that have happened after 2007, 2008. It's very difficult for people who have good jobs to get loans, especially if they had a foreclosure, in 2007. Just now, some of that's starting to clear up, and they want to own. They might have 40, 50, $60,000. You guys might say that the individual put 30 grand down. I had somebody who wanted to put 100,000 down. So don't think that you can't get the down payment either. You can absolutely get the down payment. There are people out there with a lot of money. Typically, you're going to, at least I've seen in my experience, it's been between 20 and 30,000. Those are the typical. That's the typical amount of money that people have to put down. What else? It's an opportunity. You put people in a home who otherwise wouldn't. They can. Now, the other bits and pieces, you got to be careful on some of this. I'm not a professional. I know what's worked for me. Be careful on the Dodd-Frank rules. These are the new lending regulations that have come out recently. So be careful. Don't do anything. Do a little research. Don't do anything unethical. You got to be careful with balloon payments now. But guys, I don't want to get too much more in the weeds. It's a great strategy. It works, and it's about as passive as you can get. I mean, you literally go to the mailbox. You set this up on auto pay. You get them to set this up on auto pay, and you get that every month. It's about that easy. There are the little caveats in there, but we can talk about that. If you guys have any other questions, please comment below. If you guys found this valuable, share it with somebody, or at least somebody that you think can use it and take action, guys. Look for some of these properties. If you think this is a strategy you can use, or this really makes sense, go out there and use it. Don't just, oh, that makes sense, and go on and kick the can down the road. This is something. Ask questions, and I can help you get through your first deal. Go from number 0 to 1. That's the hardest point. Go from no rentals to 1 rental, or from 0 properties to 1 property, or whatever it is. Once you get that first one, everything's a snowball from there. So guys, again, hope this helped. Thanks for watching. Appreciate it.